Could Gilead actually be an acquisition target? Well, my guest Adam, aka Dividend Sensei, provides a fire hydrant blast of reasons why he thinks Gilead is actually a great investment at current levels. He also takes a speculative look at the possibility of Gilead being an acquisition target. If so, who might buy and at how much? Welcome to the Invest in the Family Radio Show, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Invest in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we're going to make the best investments that we can. So thank you so much for joining us. Remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investinthefamily.com and subscribe to the podcast at the iTunes or Google Play Store. And always, if you want my detailed show notes from each episode, simply text the word, one word, family notes to the number 44222. That's 44222, or visit investinthefamily.com and sign up, and we'll be sure and get you taken care of. How much time do you currently spend trying to figure out your investments? Are you tired of spinning your wheels, attempting to conduct research that you really don't have time for? And if we're honest, you might not actually be qualified to do. Brett Jensen is the man behind the Biotech Forum, the #2 premium marketplace service on Seeking Alpha. He's also a top 5% ranked analyst according to TipRanks. Do you like owning companies that get acquired? So does Brett. Are you anxious about the current election season and how it may impact your portfolio? Perhaps it's time you put a portion of your portfolio on autopilot with Brett as your guide. Visit biotechforumsa.com for more information. That's biotechforumsa.com. SA as in Seeking Alpha, biotechforumsa.com. And I hope you enjoyed today's show with Adam, the Dividend Sensei. Wait, Adam, welcome to the show.
Thanks for having me on, Brian.
Honor to have you with us. And I'm excited about today's topic. Recently, you wrote an article titled, "You'll Never Guess the Biggest Risk Facing Gilead Investors." And that definitely piqued my interest. And you wrote a great article. And obviously, a lot of other people were very engaged in the conversation that you created or started. And I would love to bring that conversation to our listeners here on the Invest in the Family Radio Show. Do you mind giving us a brief thesis or overview of what that article was about?
Sure, Brian. So basically, from a long-term dividend growth perspective, it's a value-based approach, much like what Warren Buffett does, where you're looking for great companies with great management and a great track record. And, from time to time, the market gets irrational and things sell off. And so the key is, you want to look at what's cheap and then, dig down deep and see, what is the market saying? What's the actual potential in terms of future cash flows and how that applies to the dividend, of course, because, if free cash flow per share is growing, then that allows you to grow the dividend over time. And studies show that, a good rule of thumb for long-term projected returns is yield plus dividend growth. And so, if you can have a nice, healthy, secure dividend that's growing over time, that's pretty much all you need to end up beating the market. And, whether you're looking for income or, total returns, whatever your goals are, for example, like in retirement versus you're young and just trying to save up and build up a nest egg so that you can retire, dividend investing is a great way to go about it. And so Gilead, it popped up on my radar when it started, few years ago paying a dividend, and its payout, the free cash flow payout ratio is extremely low at 15%, and they just raised it about 8.5% after the first year. So they show some good strong growth, and with the cash flow, with the payout ratio as low as it is, I could easily see them growing at double digits for a long time to come. And so if you look at the yield of about 2.5% with around 10% growth potential, that's about 12.5% projected returns that you could realistically expect, and that's about 55% greater than the market's historical return. And so that instantly, put it on my radar. And then when I looked into it, it's like you got a, very solid track record. They've been around for 29 years. The thing that I really like is the corporate culture that, spans multiple generations of management, where you have, disciplined approach to R&D, disciplined approach to acquisitions. And that's a big thing because, a lot of people will try to stay away from biotech and pharma because it can be a very confusing thing. I mean, just for example, it's like only 1 in 5,000 drugs that ever starts a trial ever ends up making it to market. And the latest studies I've seen say that the average cost of developing a drug, including marketing and follow-up safety studies, is about $2.9 billion. So this can be, extremely risky, a very expensive proposition. And so, knowing where to invest your R&D dollars, because R&D is the lifeblood of the biotech and pharma industry when it comes to growth. And so you can either do it in-house and try to develop your own drugs, or you can try to acquire people. And Gilead's been very successful at doing both over the last 29 years. And if you look, for example, since 1990, they've increased their share, their total returns price is up about 130-fold. So investors have done really well, and that's including the 33% fall that it's had over the last 18 months. And that fall is what interested me, because when you look at some screening results, it's trading for less than 7 times forward earnings, and it's by far the cheapest in biotech and pharma right now. And if you look at their actual, profitability and margins and returns on shareholder capital, it's absolutely phenomenal. And part of that is because, the discipline I talked about, that they put the R&D dollars to where they think they have, the biggest edge. And they also have a very solid, low-cost manufacturing process that really helps keep those margins up. And so, I was looking at that, and there's a lot to like about it. And now that, when I went ahead, and the biggest thing, of course, is like it's a quality company. But as you know, it's like, a quality company at the wrong price can be a bad investment. But at the same time, as Buffett says, a great company at a fair price is better than a fair company at a great price. And so when I looked at the valuation, there's, valuation can be a tough thing, especially in an industry like this where it's essentially a blockbuster model, where, this isn't something like Procter & Gamble or Coca-Cola, where you got slow but steady growing in sales. It's kind of very lumpy sales growth and earnings and cash flow just jumping up and down all over the place. And really what you want to see is long-term shareholder wealth creation. And that's where something like buybacks can be a huge benefit, because, if you're decreasing your share count over time, and you're, reinvesting into R&D and wise acquisitions and growing that pipeline over time, and that pipeline comes out, more successes than failures, then gradually over time, sales and cash flows will increase. The share count comes down. That free cash flow per share increases, and that's how you can grow the dividend over time and achieve those market-beating total returns, which is the goal that I'm trying to help people realize. And so, when I looked at the valuation, looking at it, I start out looking at it historically, and then, I also take a look at Morningstar. I'm a big fan of the way they their valuation models, and then of course my own 20-year discounted cash flow analysis. It's just, this thing is absolutely just, right now, for example, it's trading around $81, and basically my models say it's worth anywhere from $140 to $200, depending on, what kind of growth assumptions, conservative versus best case. But so that's about $170. And some people might, peg it more like, Morningstar says it's worth $124, but still that's a huge discount. Sure. And so, that's the thing right now is like they just have some great blockbusters. Their pipeline, it was 40. Now they just had one less than successful test, but they're still looking around close to 40 drugs in the pipeline. And the top 4 candidates, analysts are expecting those could bring in as much as $24.5 billion a year in sales. And to give you a sense of context, right now their sales are around $32 billion. Wow. So that's the thing. There's a lot of growth potential. And, right now the market's down on them because, Harvoni and Sovaldi, they're hepatitis C drugs. When they were coming out, the FDA, they're pretty much hinting, hey, this is, as soon as this is approved, this is going to be, a revolutionary new treatment. It's going to be a lot shorter. It's going to be a lot safer with less side effects and 90% cure rate. And so, doctors basically just warehouse their their patients that they were looking to treat and said, hey, let's wait for this drug to come out. And so when it came out in 2013 and 2014, you saw basically from 2013 to 2015, sales tripled at the company. And, to give you a sense of scale, last year, Harvoni and Sovaldi brought in $19 billion in sales. And so it just, it was a gusher of cash. And, unfortunately, you know how the market is. It can be very short term. What have you done for me lately oriented? And so now, of course, with some new competition like Merck's Zepatier coming in, lower cost and not as good of a safety profile, but still, cost is a big thing. And so, it's starting to steal some market share. And of course, when you had all that pent up demand, just sales spiked all at once. And now, of course, that's coming down. As you would expect, but that's the thing. The market sees negative growth, and they're saying, okay, well, we've got some increased competition. We've got Glaxo's coming out with their own products. Johnson & Johnson's trying. Pfizer, of course, is going big on biosimilars, which is basically another term for generics. And they're a lot of well-capitalized competition, and that's just the name of the game in pharma. Is that anything that works well is anything that makes money, naturally competitors are going to try to come in and take your market share, and that's going to hurt margins. And of course, there's also we've seen a lot of political risk with the presidential election, and people are looking at some of the costs of these treatments, like Harvoni, when it first listed, the list price of $94,000. And when you come out and say, hey, look at this treatment, it's going to cost $94,000, that, that's, you're gouging customers and when you should be trying to save lives. And it's kind of, that's the thing. You have to look at it in the context of, hey, it costs around $3 billion to develop these drugs. Only 1 in 5,000 ends up, making it successfully. So, these blockbusters have to pay for a lot of failures. And on top of that, you also got to consider the fact that, it's like hepatitis C. Well, that's destroying your liver. So, that's essentially one of the most important organs you have. I mean, it basically keeps you alive in between meals. It detoxifies your blood. It does dozens of things. And so if you don't treat hepatitis C, eventually your liver is going to fail and you're going to die. And the cost of a liver transplant is anywhere between $250,000 to $500,000 plus, can run to $1 million depending on how, the age of the patient once you look at a lifetime's worth of anti-rejection therapy. So from that perspective, even $94,000, basically that's 1/10 the cost. So you're actually, saving money, you're saving lives. You are in fact making, people much better off. And so unfortunately, that kind of nuance is not something you can slap on a bumper sticker. And, and so that's the thing is like, for any kind of dividend investor, considering pharma or biotech, you just understand that there's the three risks that you're looking at, whether or not the pipeline makes it through FDA approval, the regulatory risk of whether or not, the government, Medicare, Medicaid is willing to pay for it, and whether or not various kinds of regulation go in to prevent quote unquote price gouging. And then, from my perspective here, what I was describing is, because you have such high volatility, it's like these oftentimes with the biotech stocks, especially more so than with big pharma, something like Pfizer, Johnson & Johnson, Merck, where it's a little less volatile because essentially it's a different class of investors where it's a higher yield. It's more focused on the dividend, and biotech is more towards a growth oriented model. Although now, of course, we're seeing some of the better biotechs are becoming great dividend stocks. And that's the perspective I'm trying to share with my readers. And so that's the thing with, if you look at Gilead from 2011 to 2015, the share price went up 500%. So that's a 6-fold increase. And you had some people who, if you bought it at the absolute top, about 123, and recently it fell down around to 75, 76. Now, that's the thing is, that's understandably some people look at that and say, hey, 18 months, I'm down 36%. This looks like it's dead money. And, sales, if you look at what market analyst expectations, it's going to be kind of hard to grow going forward. And that's then, understandably that a lot of shareholders might be looking for, a chance to get out. And then if you actually look at their pipeline, they've got some, like I said, some very strong candidates. Sutsumab it's a NASH drug, or it's a non-steatotic hepatitis, which basically just means that it's non-viral hepatitis, where, obesity, the amount of fat you have basically ends up accumulating in your liver and damaging it. And so, with the obesity epidemic in America, already 1 in 20 Americans have this condition, and there is no medication for it at all right now. And so, it's a huge potential market, and analysts are saying that Sitsumab could be a $12 billion blockbuster. And, then they've got their bread and butter before the hepatitis blockbusters of 2013 was HIV. And that they still control about 2/3 of the HIV market, which is about $15 billion. So they have $10 billion in sales of that. And, they're coming out, they just came out with a new drug called Genvoya, which is, already in the last quarter, they're looking around $3 billion in sales, which means that, with Harvoni dropping back a bit, this is now their biggest drug. And so that's the thing, is that they have a very valuable patent portfolio and pipeline. And even with the decrease in the hepatitis drugs of Harvoni and Sovaldi, that's going to stabilize just over time, because those are still great drugs, and they're so the decrease in sales is going to stabilize over time. Epclusa just received FDA approval, which is another potential $10 billion drug. And so there is a lot to like. And with Gilead trading at dirt cheap prices, somebody could come in and make an offer. And so I was pointing out that if you bought at the very top, and I'm a big proponent of always buying on dips. If you have a quality stock, you buy it, it's at 120. I would have been a buyer too. Had it been on my radar, I would have bought it at 120. And then if it fell to 100, I would have bought more. And then if it fell to 90 and 80, that's the thing, is like, some people refer to it as catching falling knives, but the difference that a lot of people don't realize is, and I see it in the comments, if you talk positively about some companies, then the readers will say, oh, well, if it's such a great company, look, in the last 2 years, the price is actually down. And so there you go. Management's a failure and the company's a bad company. And what people have to realize is that over a 1 to 2 year period, share prices and fundamentals have very little in common. And it really comes down to it's a popularity contest. In fact, there's a famous saying about how, in the short term, the market is a popularity contest, but in the long term, it's a weighing machine. And so that's what you got to focus on, is the fundamentals of the company. And so for biotech, you look at, the strength of the different drug brands, that look at the pipeline, and for me, of course, the biggest thing is you look at management, you look at the corporate culture, and then, of course, from a dividend perspective, you want to see, do you see management that is friendly to shareholders and willing to increase that dividend over time? And with Gilead, I do. And so I'm very much, it's the next stock I plan to buy, which is, according to my bank, the money should hit my broker on Friday. So I'll be buying Gilead on Friday, and, barring some kind of major takeout that takes it up to over $100, definitely at this price, I'd be happy to buy it. And I'd be hopefully, looking to just keep adding over time. And if it drops, I'll pick up some more at, larger and larger quantities to keep my cost basis as low as possible, because, the cheaper you can buy it as that dividend grows over time, yield on cost. I'm a big fan of that concept. If you look at it, for example, if you buy, right now their dividend is close to about $1, or no, it's about $1.62. And so that's the thing. Like, if that doubles over time and the price stays the same, well, now you're looking at, 5% yield. That's just absolutely phenomenal in today's interest rate environment. And so if the price dips down to 70 or 60 and you manage to buy more and more over time, and now your cost basis is $70 and the dividend is 2 or 3 times more in 5 years, then basically, I mean, just from the income perspective, you're making great returns. And then so that
Can we? I want to hear. I'm not sure if you're going to get there here in a minute too, but I do want to. You mentioned the possibilities of a buyout while ago. I'm not sure if you're going back to that or not, but I would like to hear more about that if possible.
Like yes. So like I said, that's my style of investing. I look at it as long-term, hold forever if possible. And so my big fear is that, is like if someone takes them out because it's, there's so much to like and the valuation is so nice that basically in a buyout, now Gilead, they're about $100 billion company. And so you'd be looking at, premium of at least 30 to 40%. So you're looking at around $130 to $140 billion acquisition. Not many people can do that. And it would likely be, some kind of combination of cash, stock, and debt. And so that's the thing is, if you're looking at it, I was looking at who could potentially buy them. And is that someone that I would be, interested in owning, or, would you have to essentially just take that small premium and, just potentially just, call it quits and move on. And so, in the article I mentioned, like Amgen and AbbVie are two of the bigger biotechs that might be potentially interested. But the thing is, it's like right now their managements are not really interested in that kind of big acquisition. It's the same thing. Johnson & Johnson, of course, world's biggest pharma company. They could always pretty much take out anyone, but management recently came out and said, hey, we're more interested in bolt-on acquisitions. And so really that just leaves, Merck and Pfizer. And Merck is also right now kind of focused more on just bolt-ons. But Pfizer has been, the biggest, known for their giant acquisitions. You look, trying to take out AstraZeneca. Now trying to take out Allergan a year ago for $160 billion, and both of those ended up falling through. And so, potentially they could go ahead and take out Gilead. And so my article basically, goes through some, models and takes a look at, the combined cash flows and sees how accretive it could be. And finds that, it would make a lot of sense for them to do it. If, buy it from anywhere from $100 to $120 a share. And so that's the thing is, it's a bit of a speculative article, but the point I was trying to make is that when you have a quality company like this, you shouldn't be scared of, the price falling. And it's important to take advantage of that, because that if you end up buying at the top, for say 123, and then someone like Pfizer comes in and says, hey, we'll take them out at say 125, 130. You might end up holding for 2.5 years and basically wind up with essentially making no profit at all. And so now you just had a lot wasted opportunity versus someone like me who, buying more hand over fist. That's the thing is like, it just so happens that I like Pfizer, so I would hold on to those shares. But, not everyone's in favor of Pfizer's management style, where they make giant acquisitions and then try to cut costs, including sometimes R&D, slashing that. So, in that perspective, if you're not someone who wants to own Pfizer, and if Pfizer buys you out at 125 or 130, then basically, you would not be happy with that kind of situation versus if you took the time to, buy on the dips and take advantage of that market irrationality, then you walk away with a nice healthy profit, some dividends along the way. And then, you can consider whether or not you want to hold on to those shares of Pfizer.
So the argument is that in reality, the company is probably, from an investor perspective, is much better off not being purchased because of all the things you mentioned as far as their pipeline, their cash flow, and lots of benefits to owning the stock over time. And you put a price target on there from anywhere from 140 to 200. Morningstar is saying 120. And so if Pfizer comes, you mentioned Amgen, AbbVie, Johnson & Johnson, Merck, Pfizer. And of those, Pfizer is probably, if someone was going to buy it, they're probably the most likely because of their history. But the thing is, if they did buy, that would give current investors that'd be if they bought at 120, 100 to 120, that could be as much as a 50% premium right now, which would be really nice, but long term would not compare with what value an investor would probably get out of Gilead if they don't get purchased. Does that sound right?
Oh, yeah. I mean, that's kind of the thing is like typically long-term buy and hold investors, we don't want to see our companies be purchased because really the premium typically anywhere from 30 to 40%. It's a nice short-term pop, but the companies we see, we want them to compound over time. And so, like I said, Gilead, if you look at it, historically, these guys, 10, 20 years down the road, they could easily be a 10 or 20 bagger. And so, you giving up 1,000% potential profit for a 50% gain, assuming you bought at the very bottom. And so that from my perspective, it's kind of sad. If the company that buys Gilead is someone that I don't like, and, I just look at it and say, I don't like the management style, that means now I've got to take that money and go find something else that's just as cheap and just as good of an opportunity. And so, that for most people, that's the thing. It's not the best thing for long-term investors.
So how likely do you think of as Pfizer being an acquisition? You mentioned this was a kind of a speculative article. Do you really think that has a chance of happening, or does that seem like a pretty big long shot?
Well, it makes sense. If it happened, that's the thing. Is like from Pfizer's perspective, it comes down to what they think Gilead's board might accept. Now, a lot of commenters, of course, pointed out that one person ran some numbers and said, well, Pfizer, it would be accretive to earnings at any price up to 300. Johnson & Johnson could pay up to 400 a share, and it would still make sense. But obviously, that would just that's running out to see at what point it's a break-even price. And so,
you think saying Johnson & Johnson could offer $400 a share?
Yes, and at which point it would still, be accretive to earnings. But you're looking at, it's like, it increases earnings per share by 1%. So that's the thing. It's like for them to do that, you'd be looking at, $500 billion. It would have to be massively dilutionary to the current share number of shares. And so, obviously that's not going to happen. Now, in terms of what's the likelihood that Pfizer might, try to offer to buy out Gilead. Well, that comes down to, like I said, is current management, would they even, entertain such an offer? That's the thing is like, now I'm, like I said, I think, and I just want to point out, I'm not saying my price target is 140 to 200 because I don't believe in price targets. I'm saying that, based on, my valuation models, I think that the company itself is worth 140 to 200. And so the issue is anyone going to try to offer, a premium to that? Right. And so that's the thing. Like, if you offer, say, a 30% premium to 200 and 260 a share, then I'm sure the board would take that. Yeah. And they'd be like, yeah, this is awesome. Let's take that and run because it's essentially quadrupling the current price.
Tell me this real quick too. Like you mentioned, Pfizer is known for like giant acquisitions, and they had two that have fallen through recently. You said that Gilead is valued at around $100 billion as a company right now. How big were the market caps of the two companies that Pfizer tried to buy but was unsuccessful on? Were they a lot bigger than Gilead or in the same price range?
So for AstraZeneca, I believe they offered about $107 billion, and I think that was about a 20% premium. Of course, that's the thing. It's the difference between pharma and biotech is like essentially how big are you and how fast are you growing. And so that was pharma taking out pharma, and Allergan is about the same. That was a $160 billion deal attempt. Now with Allergan, that was a bit different because Pfizer was trying to invert and become an Irish company for tax reasons, and essentially the government came out and said, "Oh, we're changing the rules, so you can't do that." And so once they did that, it really didn't make sense. So that just killed the deal. But that's the thing is like so. Pfizer has basically proven that, in terms of non-tax related deals, they're willing to go up as high as, maybe 110, 120. And so that's the thing for them
which would be a pretty small premium for Gilead right now.
Yeah, that's what I'm saying. That I would say at least a 30 to 40% premium is what they would need. So they could theoretically do it. It comes down to whether or not management wants to, if they feel any pressure to, after two failed attempts to really, boost their share price that way. Now, the thing with Pfizer is, either way, if they were to buy Gilead, it would like I said, the numbers say that would help potentially boost their dividend growth to 10% from currently around 6 or 7. And so in the long term, that would be great for investors. If they don't, it's still a great company, 90 drug pipeline that should do well, should be able to keep growing the dividend around 6 or 7% with a yield 3.5. So that should also help beat the market. I'm a big fan. I plan on buying them as well. But that's the thing is, like, I mean, with Gilead, the price has kind of recently it went from about 76, now it's up to 81. So I mean, if the price were to drop here, if the market, for example, were to have a correction and Gilead maybe were to drop below 70 or to 60, I could definitely see Pfizer trying to do it. Well, depending on how their share price would do, because obviously they would have to it would have to be a pretty big all stock deal, because Pfizer recently has been making some smaller bolt-on acquisitions. They don't really have much cash left.
Awesome.
So,
well, yeah. Well, we'll probably need to wrap it up for today for time purposes and stuff. But Adam, thank you so much for coming on the show. And did you have any last minute things you wanted to throw in real fast?
Yeah. So anyone, that's the thing is, if you want to learn more about dividend growth investing, you can check out my website, dividendsensei.com. I have links to all my articles, as well as general articles about how to invest better, how to think about investing, analyzing the economy and the markets in general, from me and some other great writers. So, go ahead and check it out if you just want to learn about investing in general.
Awesome. Adam, thanks so much for coming on the show today. I appreciate it.
All right. Thank you, Brian.
Well, I hope you enjoyed today's interview with Adam, the Dividend Sensei. Remember, you can get full show notes with links into the details at investinginthefamily.com, and you can subscribe to the show at iTunes, Stitcher, or the Google Play Store. But if you want the highlights, the full detailed summary sheet of this show, it won't be on the website or anywhere else. You can text the word Family Notes. That's one word, Family Notes, to number 44222, or visit investinginthefamily.com and sign up for the email list, and you'll be able to get special access to those notes. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.